today I've got a real estate guy here who's going to give us some insight on how to invest in real estate. Should you? Some ways to decide which one is and is not a good investment. And I'd like to also take him down the road of what's the difference between investing in real estate before retirement and how does it change after retirement.
You're listening to Advised with Rick Luchini.
I've got Austin Preece here from Preece Financial Planning, who is a financial planner primarily working with business owners and real estate investors. So Austin, I'm just going to start with bouncing it over to you and give us a couple just top line pros and cons of what you see of investing in real estate.
Yeah, sure. So I guess, first of all, there are a couple of different ways that people do invest in real estate, right? I think a lot of times people just kind of, they hear about house hacking or something like that, so they're like, I'm going to go buy a duplex. I'm going to live in one side and I'm going to rent out the other side. And maybe they start to build a portfolio off of that and don't really realize that when you buy real estate as an investment, you really are buying yourself a part-time job, right?
Yeah.
So that's kind of more who I deal with. The people who have long-term rentals or long-term holds, I should say. I don't work with a lot of people who do a lot of house flipping.
Okay.
That's kind of something altogether different.
Yeah.
But people who hold houses for, or other real estate for long-term and rent it out.
Yeah, commercial real estate that is for cash flow purposes,
right?
Basically.
Yeah. Whether it's residential or office space or industrial, all that stuff I deal with. So
well, I think you bring up a good point right there because it's something that I bring up a lot, which is, and this is not don't do it. This is just consider it, especially when you're younger, you can get away with it, which is everybody wants to talk about passive income, buy a rental property, passively get paid and like golf all day or something like that. But what you're doing is, depending on how many properties you have, you're either creating a business or at least at bare minimum, a like side hustle, because you do have to commit some time to it.
Right. Yeah. Well, and I think the mistake that a lot of people make is they don't think about it as a business. They think about it as a rental property, and they think about it as passive income. And even if you want it to be passive income, you need to think about it as a business from the perspective of, what's the revenue coming in and what are my expenses and how do I maximize my cash flow, and when does this investment no longer make a lot of sense for me? So those are the things that I think people kind of miss.
Well, give us some of the why do I want to? What are some of the pros? You don't have to compare it side by side with stocks, but I think in most people's mind is I have $1 or 100,000. It doesn't matter how many zeros are behind it. I have $1 to invest. If I'm going to put it somewhere, I know at least generally how the market works and the pros and cons of that. What are the pros and cons of real estate, and why might I look towards that for some of those dollars rather than just sticking it all in the market?
Yeah, well, I mean, I think first of all, for a lot of people who start investing in real estate, part of the reason is because it's tangible. You can see it, you can go walk through it, you can do work on it yourself. And you and I have a decent understanding of stocks and the stock market, but most people don't really understand it. It doesn't make a whole lot of sense. What is this S&P 500 and who's Dow Jones? Like all.
And
all
the TV is meant to scare you. Every day, and so that's part of it too. Like I see this commercial building across the street. I know what I can get for it for rent. It's dependable in my mind, at least it's dependable. I can touch it. I can feel it. I feel like it's not going to disappear in fairy dust like this stuff on TV. And that's okay.
Right. Yeah. Yeah. It is, the fact that, you can see and go visit your properties and you can't necessarily go and visit your stocks. Now you might own Walmart. You can go to a Walmart, but it's not the same, right?
Not the same thing.
So that's part of it. That I think is one of the reasons that people get into real estate, because they understand it, and that is important, right? Number two, you kind of touched on it there. It tends to be fairly stable. It depends on where you are and kind of how the population in that area is doing. And a whole host of different factors, but it tends to be fairly stable and it tends to go up in price over time. And one of the big things that I think we don't focus on enough is it is really easy to leverage real estate. So
Yeah.
when you go buy real estate, you're maybe putting 20 or 25% down. So you buy a $500,000 property,
Yeah.
you're putting 100,000 or 150 down, something like that. And then over the next, 20, 30 years, you're using rents to pay down that loan.
Yeah.
Um, and the returns that you get are based on putting a smaller dollar amount in.
To that point, the rent
Yeah.
that you're getting or the cash flow that you're getting is based off of the building being 500,000, not
Right, exactly.
the 100 that you put in. Now, of
Right.
course, there's property taxes and interest and all the
Mhm.
other things that come into that calculation, which
Right.
I think we had talked about offline is
Mhm.
another episode. So if you're interested
Yeah.
in how do I actually like value a business if I have
Yeah.
money to invest, value a commercial property, let's say, not a
Yeah.
business. Hit subscribe. Stay tuned because I think we should do that. It's very
Mhm.
interesting. But for the purposes of this conversation,
Yeah.
I'm using leverage,
Yep.
especially at a younger age. So now I can get into a bigger property. I can
Mhm.
build some long-term wealth or assets that way with
Mhm.
less money up front because I don't
Yep.
have the $500,000 to stick in the market, even though percentage wise the return might be the same, dollar wise it's not.
Those are kind of the pros of real estate, right?
Yeah.
It's tangible, it's easy to see, it's relatively stable, it's easy to leverage, which can help your returns over the long
Well,
run.
what about the tax
Oh
benefits,
yeah, taxes.
yeah, I mean, that's your thing, right? We're gonna get into pre and post retirement later, but just kinda quickly, what are the tax benefits while I
Yeah,
actually do owe money on it, and how
sure.
might that change? Let's say I own the building outright by now, like,
Mhm.
how does that different and what should I consider tax-wise?
Yeah, sure. So really the only impact that leverage has on taxes is the interest rate that you're paying. The
Okay.
interest you're paying each year is deductible, right? The real tax benefit of real estate is that we get to depreciate this asset over for residential real estate it's 27 and a half years, and for commercial non-residential it's 39 years.
Give the non-accountant
Yeah.
listeners here
Yeah.
an idea of what that actually means and why it's
Yeah.
valuable.
Yeah, so depreciation, basically, the IRS recognizes that you're going to have to fix up the house as you own it, right? Things wear and tear
Yeah.
brings the value of the house down. So that's what depreciation helps you account for from a tax perspective. So let's say you buy a house for $250,000. You get to divide the value of the house. You have to take the land out of it, but you get to divide the value of the house by 27 and a half. And each year you get as that dollar amount as a deduction against your taxes. So it's really nice because it's a non-cash flow expense. You're not
Yeah.
actually sending money out the door,
Yeah.
but you are getting a deduction on your tax return. And
Right.
you get that whether or not you have a mortgage on the property, right?
Yep.
That said, if you own a property for a really long time, after 27 and a half years, for residential property, that depreciation expense goes away. So your tax liability might increase after that.
Now I'm accumulating wealth. I'm still
Hmm.
younger investor and I'm buying up properties. I'm using
Yeah.
leverage to take one, buy another one, all this other
Yeah.
stuff.
Hmm.
Um, at what point do I look at that and start saying, do I continue to commit to real estate or
Hmm.
do I start to diversify and say, I have all these properties. Now I need to take some of that cash flow and put it in the market or another business or something else?
Yeah. Yeah, and honestly, for the young people I know who are investing in real estate, I always encourage them to invest in the stock market as well,
Yeah.
uh, alongside. Not necessarily build one up and then do the other, but try to do both at the same time because diversification really is key. And it provides having that extra liquidity, being able to sell your stocks off at any time provides you the opportunity if there's a property out there to go and pick it up, right? If you have a big opportunity to get a property at a low cost.
Yeah.
So having investments in real estate and in liquid assets like the stock market, I think is really important no matter what age you are.
Yeah.
But like you were alluding to, as you get closer to retirement and maybe
Yeah.
start to need money to live off of, you're going to have cash flow from your real estate, sure. But it's possible that you might have a tough time finding a tenant for a property at some point,
Yeah.
and well,
Well,
it'll be nice
yeah.
to have some liquidity to fill that gap.
Yeah, and here's the thing about that. You're assuming then you're assuming that the person doing that knows what they're doing.
Right.
So just like buying a bad stock, the next dollar in isn't always in the right place, right?
Yeah.
So just because it's real estate and
Yeah.
just because maybe you got lucky on the first one, you
Hmm.
actually have to know what you're doing. That's why we're talking about why don't you just take 2 minutes and give us the high level overview, how like some of the things to consider if I'm looking at a property and I want to know either A, is it a good investment, or
Sure.
B, how to compare it to another property side by
Yeah.
side. Two commercial properties are right beside each other on the street. And
Hmm.
how would I just real high level, how would I look at the two of those? And then we'll move on to retirement.
Yeah, yeah. So assuming they're the same price,
Yeah.
you're going to want to look at well, even if they're not the same price, you
Right.
have dollars to put to work. We want to figure out what the expected return is going to be
Yeah.
um, based on the number of dollars that you put in.
Yep.
So when I'm looking at the returns of real estate, I look at four things. I look at the cash flow that you're going to be receiving after all expenses are paid. So that's your rent minus your taxes, insurance,
Yep.
utilities, mortgage, all that. The money that shows up in your bank account at each month. And then I also look at how much you're going to be paying down in principal on the mortgage because that is also returned to you.
Yeah.
I look at the depreciation benefit, so the amount that you're going to be saving in taxes because of how much you're able to depreciate each year.
Okay.
And then lastly, I look at the assumption that we have for the appreciation of the property.
Okay.
So that's a pretty tough one, right? If you
Yeah.
think that you can turn it around and increase the value of the property quite a bit, raise
Yep.
rents, that might be a reason to choose one property over the other. But looking at it that way and then taking all that return and basing it on how much money, how much cash you're actually putting into it, allows us to not only compare property to property, but it allows us to compare property to bond, to
Yeah.
stock,
Yeah.
to really any other investment. So that's
Yeah.
that to me is why it's really important to look at it that way,
Yeah.
because real estate is not always the answer, and
Right.
you can't go into it thinking that way.
Well, and that's why I wanted to bring that up, and we will do, or we can do another episode where we actually say how to do these things and how like the
Yeah.
technical side of it. But just listening to that list,
Hmm.
if you're listening to this episode and didn't like completely understand everything he said, don't just run out and buy real estate because somebody on social media told you that's how they got rich. Learn this stuff or ask for advice because not all properties are created equal, and just
Hmm.
because it's convenient that the one you drive by to go to work is for sale doesn't mean it's a good investment,
Right.
right? And I think that's
Absolutely.
that's what I see a lot in
Hmm.
my practice is um folks coming in ready for retirement. They're not real estate investors
Hmm.
per se. They're folks that have accumulated some real estate along the way. Maybe they had a business and they don't operate out of that building anymore, but still own it. Or maybe they bought the house across from their rental house in Florida or like whatever. And that's okay. Most of them have done well accidentally.
Yeah.
But now that those dollars and cash flow matter a little bit more, they don't actually know how to analyze,
Hmm.
is this worth continuing to hold? What's
Hmm.
the ramifications if I don't, tax wise and cash flow wise?
Yeah.
And is my dollar better in here in the market? And the other thing, and I'm going to let you go on this, is that I hear about a lot is, and again, these are not real estate investors like I built a business this way. This is like
Hmm.
the guy had another job and bought two properties along the
Right.
way. He doesn't want to worry about it anymore.
Yeah.
He's just getting ready to retire. He
Yeah.
doesn't want to worry about rents and vacancies and the, you know, the guy that he pays $3,000 a year to plow the snow didn't show up, and the people are like, he doesn't want to do it anymore.
Right.
Okay. That's different than someone being a sophisticated real estate investor. I get
Mhm.
that.
Yeah.
But like, why don't you talk a little bit about the transition
Yeah.
mentally and actually financially
Yeah.
from I'm young, I'm hungry, I'm accumulating all this stuff. I think it's great. And now I'm like getting ready to retire.
Mhm.
What's the difference?
Yeah, yeah. So, uh, one thing I want to make sure we touch on is just the the tax strategy that's available in real estate. So you talk about someone who maybe it isn't their whole life to build this rental property portfolio, but they ended up
Yeah.
with one or two, or they
Yep.
ran a business and used real estate for that business. So it's an investment property.
Yeah.
Um, if you sell that property just outright to invest it in the stock market, you're going to have taxes on the capital gains. So, however much that property appreciated over that time, and you're also going to have taxes on the depreciation that you took while holding the property.
Right.
Depreciation recapture is what that's called, and it's a higher tax rate than capital gains tax rates. A lot of people don't understand that.
Yeah.
Now, one of the beauties of our tax code is that if you hold something that has gain in it until you pass away, that gain disappears upon your passing. In
Yep.
community property states, the gain goes away with the passing of one spouse. In the rest of the states, the normal states, I'll call them, um,
Yeah.
you get a half step up. But if you're single and you own the property outright, then it gets a step up in basis at your death. So that oftentimes makes people think I need to hold these properties until I pass away,
Yeah.
no matter how much work they are. But what's beautiful about real estate that you can't do with stocks, if I decide I don't like this stock fund anymore, I want to sell it and buy a different one,
Yeah.
I'm going to pay taxes on whatever that gain is, unless it's in an IRA, right?
Yeah.
In order to buy that other stock fund. But in real estate, we can do what's called a 1031 exchange, where you can exchange one property for another. You can sell your property as long as you follow all the rules, which we won't get into here. You
Yeah.
defer
Yeah.
the gains,
Kind of
and
like
and
a
you
rolling over your
rolling
401k,
over
it
your
feels
investment.
like. Yeah.
Yep.
Yeah.
Yeah. Yeah.
Okay,
And
so give me that example. I come in, I'm like, "Hey guy, I got this rental property. I thought it was great because I was working, I was there every day,
yeah.
and I was, renting it out to other businesses, and I ran my business out of it. Now I'm
Hmm.
getting ready to retire. It's a headache. I don't want to deal with it anymore, but I've
Yeah.
got $300,000 worth of gains wrapped up in this thing."
Yeah, so your options, you can go find your own, find a property to roll that money into.
Yeah.
There are also investments out there called Delaware statutory trusts that make it completely hands off. You do a 1031 exchange into this investment that holds real estate. And then, for a lot of those investments, you continue getting a monthly check, just like
Yeah.
your rent. You continue participating in the upside of the real estate, and you can continue deferring that tax
But
until you pass away.
I
Yeah.
think there's an argument to be made that a lot of people are undercharging rent that aren't
Yeah.
sophisticated investors too. And so you need to look at that. You need to evaluate if your dollar's working for you, if your dollar's tied up. Doesn't matter if it's locked up in a piece of real estate, the stock market, a
Mhm.
business. You have to think of what the opportunity cost is or calculate the opportunity cost. If that dollar wasn't there and it was somewhere else,
Mhm.
what should it be earning or what could it be
Right.
earning?
Well, and it's hard for everybody, right? It
Yeah,
comes back to part of what's difficult about investing in real estate is, maybe you're a super nice person, but in order for you to make this work for you, you have to charge the right amount of rent, and you're going to
that's
have to
right.
raise your rents on people, and that's really difficult to do.
Yeah.
As someone who owns a business, I hate raising prices,
Yeah.
but it's just part of the deal. You have to be able to do it.
I want to make
Hmm.
one point that we've said a few times, but I think is super important. Just like the stock market, just like being a partner in a business or anything else, not all are created equal.
Hmm.
There is a there's a lot of flashy people that have made or are making their money in real estate. And you can do that, but it isn't just blanket buy the building across the street because
Right.
now I own real estate and that's great. I mean, there's a lot of other factors to analyze and there's a lot of opportunity cost to tying those dollars up. And
Mhm.
so if you're buying a building and you don't know the math behind it, there's a good chance that you might not be on the right end of that deal. It's about
Right.
having a strategy, knowing
Mhm.
what you're doing when you put those dollars to work,
Mhm.
and then over time diversifying, whether it's diversifying with different properties in your portfolio or like you mentioned, diversifying with stocks and with real estate.
Yeah. Yeah, absolutely.
All right, buddy. I like that. Tell people where to learn more about you and listen to what you have to say. And I think
Sure.
I'm going to have you back and we're going to geek out on
Yeah.
the guy that's listening to this or the gal that's listening to this that says, okay, I'm super curious about real estate. I want to get into it. How do I actually evaluate it? Like I'm looking at 3
Right.
properties on Zillow right now. Let's do that and just tell them flat out, here's the math. Here's how you do it. But tell people how to get in touch with you or learn
Sure.
more.
Yeah, yeah. So, Rick and I met on LinkedIn. We're both pretty active there, so you can
Yeah.
find me on LinkedIn and Facebook. Austin Preece is how you'll find me. I don't think there's another one out there. And if you want to check out my website, it's preecefp.com. It's PREECEFP as in financialplanning.com.
All right, buddy. Thank you.
Yeah, thank you,
Talk to
Rick.
you soon. Yep.